Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So in this video, we're going to be talking through all things IPOs, initial public offerings, the first time that the stock or the shares of a particular business get offered to the public, and everyday people can go out and buy and sell shares in these new really cool businesses. There are some very hot IPOs that have happened over the last couple of years, but overall I think it's quite a misunderstood topic in terms of how a company can actually benefit from an IPO, the reasons it would do it in the first place, and the things you should be looking at in terms of that IPO actually being a good investment for you. So that's what we're going to talk about today. Now before we get into that, we do have a sponsor for today's video, and today's sponsor is Hatch. Now Hatch have been sponsoring the channel for a few months at this point, and they have been my personal broker of choice for all of my US investing from here in New Zealand. So I initially switched across, frankly, just because of fees. I was stuck paying $90 US a trade at a large bank, which I also had to do over the phone, by the way. I can now do that online, and I could do that same trade for $3 US over in Hatch. So massive money saver in terms of fees versus many of the big banks that offer US share trading. They also have several blog posts, of which I've been writing a few recently, and they also have one on IPOs, which is the topic of this video. So if you're interested in checking out Hatch, you will need to go to the link hatch.as/investingwithtom, sign up, create a new account, and deposit 100 New Zealand dollars into that account, and you will get an additional 20 New Zealand dollars added so that you can get started investing with a little bit more cash. So IPOs, they are quite a popular but often misunderstood topic, and I want to talk through that today and try and talk you through some of the motivations behind some of the people that are involved in IPOs, how they actually work, the reasons people would want to go public in the first place, and all of the things that kind of combine together in order for you to help figure out whether or not this is a good investment for your particular portfolio when you're looking at a company that's going public for the first time. So for this example, I'm going to use this YouTube channel. Let's hypothetically say that I want to make this YouTube channel a public company. Investing with Tom Incorporated is going out and it's going to go IPO in 2020, and we've got some big plans in terms of what we want to do. So let's just say, for example, currently I'm doing these videos literally in the corner of my bedroom, and I want to drop tools from doing this, and I want to go out, funnel a whole bunch of money into hiring a film crew and better cameras and all this kind of stuff, and I want to go out and film some sort of documentary or educational series on investing that's we're going to try and get on TV, for example. This is some sort of big project. We've got a big audacious goal that we want to reach, and I fundamentally don't have the cash to get there. Let's just say that is our current situation. Now, in order to get the cash to go out and film this documentary series and hire a film crew and do all this stuff, really I've got a couple of options. So the first thing I can do is I can go to the bank and I can get a loan. When you are working an everyday job and you go and get a loan on a house, generally that's a fairly straightforward process. Many people go out and do that all the time. But when you're a small business, particularly a startup business that doesn't have a lot of revenue coming in, maybe you're not profitable yet, the banks are they're much less likely to want to lend you money. So that takes us to option two. And option two is looking for outside investment. And that can come in a few different forms. So either we can go and find some sort of venture capital money. So this is a private investor that is willing to, take a percentage of ownership in Investing with Tom Incorporated and give us some money as part of that to go out and do this project. Or the other option is that I can go public. I can sell my shares to the general public. I can be listed on the stock market so that investors that do buy into Investing with Tom Incorporated can sell their shares at any time. And we can have an active kind of liquid market for shares in Investing with Tom Incorporated. So anyone can buy and sell their shares any day of the week. There's no issue with like in private investments where you purchase into a company, it's really, really hard to sell. It's liquid, we can raise capital, we can do all these different things. That is a great reason that I might want to go public and do some sort of IPO. Okay, so now let's look at the IPO from my perspective, the current owner of Investing with Tom Incorporated. Let's say I own like 80% of the shares. You know, maybe when I first got started, I had a friend who, bought the camera for me, and I told them as a thanks for that, I'd give them 20% of my earnings for the rest of time. So, you know, they maybe own 20% of the company, I own 80% of the company, and kind of run the whole thing. I'm sort of the CEO and founder and all that kind of stuff. So let's look at things from my perspective. Now, my goal when going IPO, when going public, is to raise capital, firstly. So I'm going to need some money that I don't currently have in order to do this documentary series. And the second thing that I want to do, ideally, is sort of limit the damage. So, you know, I currently own 80% of this company. I'm confident that this documentary series and so on will do quite well. So, you know, if I think the company is going to be successful over the long term, which I definitely should if it's my company and I'm running the thing, then I want to raise as much money as possible and give away as little equity as possible. So after this IPO transaction, really I want to still own as close to 80% as I possibly can. That would just make sense for me financially if I think this company is going to be successful, to still own as much of it as possible. So in order to try and achieve those two things, raise as much money as possible and still own as much of the company as possible after an IPO, when I sell some ownership, some shares to the public, I'm going to need to make sure there's a lot of interest in people really wanting to buy into this company. So that is going to lead me to the next step of going public, and that is hiring some sort of investment bank. Now, investment bankers are heavily involved in the IPO process for a lot of companies. They handle a lot of the administration side, but more importantly, quite often, they are involved in basically marketing the IPO. So, you know, there's not possibly that many people out there that have ever heard of Investing with Tom Incorporated. So in order for me to have a lot of interest and a lot of potential buyers of my stock when I go public, we're really going to have to put a lot of effort into marketing Investing with Tom Incorporated, helping people understand what the business currently does, but more importantly, how successful we think the company can be in the future. And that's going to help people to pay up a very large premium in order to get in quick and try and get an ownership stake in this business built up. Now, one of the other reasons that a business might also want to go public is to do with other shareholders that might want to exit the business. So I mentioned earlier that, you know, maybe I've got a friend that bought my camera and he owns 20% already of Investing with Tom Incorporated before we even go public. Let's say that friend of mine has had enough. He just wants to liquidate his stake in the business and get some cash out, basically. Go on with his life and do whatever he wants to do. Now, they basically have two options. So before we go public, possibly I can buy them out as one of the other owners of the business. They can possibly find some new shareholder, some new private investor who would be interested and getting a large stake built up in the business. But with many companies looking to go private, these are often huge multi-billion-dollar companies, and it's not that easy to find a buyer that is willing to invest that much money into some sort of illiquid asset, an asset that does not have an active share market and does not have the ability for that investor to get kind of in and out of all the time. So that's another reason why companies go public, and that's another reason again why it makes a lot of sense for the people on this side of the table, the current owners of the business. Makes a lot of sense for us to get these investment bankers on board, get the marketers on board, and try to really maximize the price and the performance of this IPO as much as we can. You know, my friend wants to get as much money as they can for their stake in the business. I want to raise as much capital as possible for me to go out and do this series, while also giving away as little equity as I possibly can. Now let's jump forward to game day. Let's say it's the day that we go public. All the hype's built up. We're ready to issue some shares. And basically what will happen is sometimes before we actually go public, we will get our investment bankers to bring in their big other investment banker or institutional investor friends. And those institutional investor friends will often get kind of first pickings at the first new shares of this public company, of this newly public company, in this case, Investing with Tom Incorporated. And then after that stage, we will hit the market. We will hit the open market. We'll sell a certain number of shares, and that is when things can sometimes start to get a little bit crazy. So with most publicly traded businesses, they've obviously been on the stock market for some period of time, and the market has been also able to track and follow the performance of that business over time. And it's not that common for really drastically different or new information to come out on a particular day. So the share prices don't move around too much. They might move around a couple of percent, maybe 10% on a really dramatic day. Maybe there's something happening in the broader market that causes those stocks to move around quite a bit on that particular day. But really, there's not a lot of new information coming out about a particular business. Markets are auction driven, and there's a whole lot of buying and selling of each particular company every single day. And that means that it sort of floats in and around a price for the most part of what people think that business is worth. Now, when a company first goes IPO, this is the first time that auction-driven market of the stock market really gets its first crack at the shares of that company. And what you can have is wildly different opinions on what public investors think that business is actually worth. Maybe I decide to raise, say, $100,000, and I want to sell each of my shares at $1. And that share price, frankly, is just a number that gets picked out of thin air. The share price means nothing. What you really need to look at is the overall value of the business. But let's say I want to raise $100,000 and I sell all of my shares for $1. That's sort of my target price at my IPO. So I'm going to sell 100,000 shares. Now, what will happen is after those initial 100,000 shares have been sold, from my perspective, from the company's perspective, the IPO is complete. I've got my $100,000. There's 100,000 new shares on the stock market. But what can happen in the following minutes and hours and days and weeks following the IPO is the share price can be very volatile. You've got brand new investors to the company, and you've got wildly different opinions on what you think the business is worth. And that can create massive volatility. Up and down. We saw with the Beyond Meat IPO, for example, I think it was up something like 70% on its first day. I'll put up the exact numbers here. And then you've got other businesses like Facebook. So when Facebook went public, that actually over a period of time went down about 50% over the course of many months after its initial public offering. But for the business, for Investing with Tom Incorporated, the share price, what the share price does over the following minutes and hours and days and months really doesn't mean anything. I get my $100,000 in order to go out and film my documentary series right out the gate. Assuming there's enough interest to buy all those initial shares, we're done. I've got my $100,000 and I can go off and film my series. And I think that's something that a lot of people don't necessarily understand, is that the share price movement, or you going out and buying shares in a company that has already gone public, even if it's just minutes or hours after going public for the first time, you buying shares in that business does not directly benefit me running the company. And you selling the shares doesn't hurt me in any way. It doesn't take the cash back out of my pocket again after the IPO. I've got the cash, the shares are publicly traded, and the stock market sort of acts as a secondary market. So rather than you going in and buying shares that are trading on the stock market, say a week after IPO, and me getting more money because you've done that, that's not the way it works. What you are doing in practice is you are buying your shares off someone else that already owned shares. There's no new shares being created or anything like that. It's just a transfer from one person to another. It's sort of like me being maybe a property developer. Maybe I sell 5 or 10 apartment units for the first time after building them. And selling shares on the stock market is sort of like, the first person I sold an apartment to, selling it to someone else that I don't know. I'm not involved in that sort of secondary transaction. So, is Investing with Tom Incorporated a good investment, and is an IPO that you might be looking at in particular a good investment? Now, basically, from my perspective, I don't think we should treat an IPO much differently from any other company that we might be looking at. It's important to understand the incentives of those within the company behind the scenes. They're trying to maximize the price they get. They're trying to limit the equity that they have to offload in order to raise that money. So that by default sort of leads us to the conclusion that most of the time, and certainly not all of the time, but most of the time, all the incentives are going to be there to maximize the price and really minimize the amount of value that you can get from investing in a freshly issued IPO. It's unlikely that you're going to get to a company that has an intrinsic value of, say, $1 million, and you're going to be able to buy it for half of that right out the gate. That's entirely possible. The business may go on to be much more successful than anyone ever thought it would be. But all the incentives are there for people to maximize the price. And this is why, with a very rare and actually quite recent exception, you rarely ever see Warren Buffett and Berkshire Hathaway investing in an IPO. It's for this exact reason. They're looking for companies that are trading at less than they're fundamentally worth. He's trying to buy a dollar for 50 cents. And people at IPOs, investment bankers, founders of those companies, they're trying to sell a dollar for $2. Or they're trying to sell a dollar for $1.50. They're trying to get as much money as they possibly can through good marketing, good promotion, all that kind of stuff. Now, that doesn't necessarily mean IPOs are going to be bad investments. Really, there's a couple of things we need to look at. So firstly, we need to understand the business. Do you understand what Investing with Tom Incorporated is actually going out and doing? Do you understand the people running the company? And really the tricky part is trying to value the business. If we take the Investing with Tom Incorporated scenario, you could maybe look at my YouTube ad revenue or something at this point and get a feel for how much money the business is producing, but you really have no idea what this new venture is going to be looking like. If a business is going out and building a new factory, or I'm going off to film this series and trying to get it on TV, really you've got no idea probably, and you might have an idea, maybe work at a TV company and you've got some really good knowledge in this area, but it's unlikely that you're going to have a solid, facts-based opinion on how much that TV show or that documentary series can actually produce for you as a shareholder. So that generally makes IPOs really tricky to value, as they're often early stage companies. Many of them are not yet profitable. Some of them don't even make revenue yet oftentimes, and it's really tricky to try and come up with a value for that business. So for me personally, I have never invested in an IPO. There's companies that have IPO'd that I definitely follow though. So I think it's a really good opportunity to start tracking a lot of businesses that you might be interested in, see how they perform over a period of time. And once they do start to get more predictable, and you can start to put some numbers behind where you think that business might be in future, that's when you can start to do all your valuations and try and understand whether this is actually a good investment or not. When you invest in something straight out of IPO, I hesitate to even use the word invest. I think that's more of a speculation. In a lot of ways, you're gambling on whether the company is going to do really well or really poorly, and there's not a lot of information that you can really use oftentimes to kind of back up that speculation or that investment case that you might have. So that is all from me today. I do hope you enjoyed the video. If you did, please hit like and hit subscribe on the channel. I will be doing a YouTube ad revenue update at 15,000 subscribers after a great response from a community post that I put up the other day. So do hope you enjoyed. If you're interested in the Hatch offer, I'll put the link up on the screen again here and also down in the description below. But that's all from me today, and I will see you in the next one. Cheers.